Hello guys, and glad to have you on board again today. We're going to add up another brick and foundation to our beautiful house in here. And of course, the thing in here is that we're going to dig into some more subjective stuff. We're still transitioning, and this is the reason why today's episode is still as well a yellow to orange stuff. It is about transitioning yourself toward the next level, which is going to be, if you're willing to go down this road, of course, it's not going to be a mandatory choice, going down some more advanced patterns. But today we'll stick with the same old stuff we've just talked about. We will use our biggest risk limitation toward the trending context. And that is by definition the safest way for you to jump into some more advanced stuff without too much risk taking. So the pattern we're using here are kind of a bridge into the easier stuff that you've learned previously, the ranging stuff, which are really easy patterns by now. You should have figured it out. We're getting some more complex stuff, but we're definitely not yet at the complexity level that you'll reach out to when you will get to more experience patterns. But basically, if you start understanding the point, today we're not just going to teach you another pattern. I'm going to try teaching you something more interesting. It's all about how you're going to go into the shaded gray areas of risk management. You'll see that at that point, starting now, you should stop seeing things as it works or it doesn't. I'm getting in or I'm not. You're going to start making decisions and see that decisions will have both probabilities of being just as good to another. It's just, it will depend on how aggressive you are. And you'll start seeing how shaded gray areas I'm so much talking about really are all about. So, well, let's get it started. It's going to be an interesting podcast, probably longer than the usual 30 minutes, to be honest, but I think it's worth the extra time. We're still going to use a PowerPoint support in the first places. I'm going to go real fast with this one because most of it and what's in here is definitely a repeat of what's been said in the previous podcast, because those patterns are similar, and we're actually going to use some kind of a symbiosis between the two. Okay, so this is really all about it. Let's get it started. Okay, so this is what this is all about. I'm going to go real quick with this first part. This is exactly what we just taught previously. So the pattern I teach you right here goes really, really parallel to the first one. Exact same context. We need to trade it post breakout. The breakout needs to be validated, stuff like that. You know all about it. I assume that as there are numbers to these videos, if you're having a look at this one, you already looked at the previous one, of course. Otherwise, stop it and go see the previous one. Okay, so that's the thing. When I'll teach you that pattern, might sound familiar to you guys who've already experienced the trade of the day sessions that I do generally into Discord. This is a similar pattern, but in a different context. So of course, make sure you know these patterns before applying. The rules I'll teach you out there are not the trend of the day's rules. They're very similar, but not exactly the same. Okay, different context means different patterns. All right, this pattern can be combined with the previous one. It can be traded alongside with it without ever exceeding the 2% maximum risk taking because of context limitation. Each and every context has a maximum risk taking. In here, we cannot exceed 2% risk taking at a current given time. Okay? Of course, through time, as we get to have safe trades back then, we'll be able to re-inject that risk later on. That's the process we've highlighted into the previous video. We're going to push it even further today. Okay? So it has to be traded 2 time frames below. That's the slight difference on the one we've seen previously, in which we were trading 2 time frames, but we were looking at the chart just 1 time frame below. We're going to have to go 2 time frames below in here because we trade only 1 time frame in this pattern. It uses the clusters of both a moving average and a context demand. So we're using demanded areas in conjunctions with a positive moving average rising to catch up on prices. And we're going to filter it out because that's frequently less effective in terms of risk-reward ratios, in terms of signal limitation. We're going to need signals. So in here, I'm going to introduce something that we're going to talk about a lot when we're going to talk about experience patterns. So this is kind of a first introduction to this today. We're going to use what I like to call cycle cluster, which is basically a conjunction of both cycles on 2 time frames in the same time. So you know how sine wave works, okay? It gives you favorable cyclical condition. We're going to use that in a multi-time frame. So you might have heard me talking about it multiple times into Discord on the daily updates and stuff like that, the trend sine wave. So we're going to use sine wave and trend sine wave as a conjunction for a signal. So it's kind of using multi-time frame sine wave to sum it up easier in an easier pattern. Okay, so this is what we're going to use: favorable cycle into a demanded area where moving averages are catching up on prices. That's basically the psychology of the pattern. What matters in here is that if you want to sum up informations, and if you understand at that point what the strategy is all about, you cannot add up things that are similar. So if this pattern were exactly the same as it was on the previous podcast, then that would be absolutely stupid to try putting them all together. So we need something that has absolutely no statistical link to the previous one. So what's the point? What's the similarities between a moving average and a breakout strategy? Totally different structures, totally different psychology. That's the reason why we can combine them. Combining two stuff that are the same just makes it no added value. Like if you have multiple patterns with moving averages, then that's absolutely stupid to try combining them. They actually do not add value, okay? Though if you want to add value, you need to have different sources combining two different patterns, okay? So this one uses moving average price as a reference with a demanded area and favorable cyclical condition. The previous patterns we've seen uses breakout strategy or pullback strategy, which is absolutely totally different. Okay, so what matter into today's podcast, not just teaching you another pattern, it's teaching you how you can use this symbiosis in a risk limitation perspective. Okay, so we're going to combine those patterns, add them up into a symbiosis behavior, but there's going to be a set of rules that we're still going to need to favor out there. Okay, let's jump into the pattern itself. So this is what this is all about. Okay, this pattern has just the same as previously, a trending reference. Okay, a reference time frame in which we are in breakout, because in here our context is a trending market. So this is our daily reference, exactly the same as before. Instead of looking at H4 time frame and trending both the context and the trend channel, we're going to go down to the two time frames below time frame scale. Okay, so we're going to look at H1 time frame, and we're going to trade in the context, not with the trend channel. Okay, you're going to activate the 20 period moving average, which is going to be linked to your context. So this is a context 20 period moving average. This is used by the indicator. I'll show you later on. You just double click on the indicator. You'll get a set of options to set on and off, and you can activate the moving average by setting its period. So you set it to 20 and you'll get just exactly all about it. You're going to have to activate the extreme context, which is no more than just switching to 3 timeframes management. So you have your trend channel, your context, and the extreme channel is basically the higher timeframes context, okay? And we're going to need this one for our risk limitation purposes. Then we're going to activate trend sine wave for the reasons we talked about previously. It's in the same panel, so you'll see this pretty quickly. Okay, so set yourself for this. And these are the things we're going to use starting now, and we're going to use these things a freaking lot into the expert context, okay? With even more accurate behaviors, because, I mean, you'll see, okay? You'll get later on into some more difficulty. So this is what the pattern looks like. Okay, it's not that really complicated. What you need to embrace in here is the context in which it occurs. So what you will see on your charts is, of course, a rising context, generally the unfolded boxes on the resistant context, because of the breakout occurring 2 timeframes above. You should have frequently trending prices out there going somehow irrational. Sometimes even the support context will be unfolded as well. At that point, normally you should see prices stopping to push toward resistant context at some point, stopping to do this, retrace at some point, which should cause the context to start folding each other again. Okay, the context boxes should be folded. You will sometimes see a third range boundary. Oh, that's our little fellow we've seen previously. So yes, of course, these patterns, even though they are totally not correlated in terms of sources, will tend to have somehow occurrences correlation. They happen into similar context, and that's exactly what we want. 2 different sources that tend to confirm each other. So this is added value. Of course, that doesn't mean we are confident enough to say, oh, well, we're going to double the leverage. Definitely not. We're just going to use that to risk limit even better than just one pattern, okay? I'll get to this later on, you'll understand. So sometimes you'll get a third range boundary, sometimes you won't. It's not really a big deal. We don't give a shit. That's not part of our pattern, okay? What matters in here is that we get the cluster in which we do have both a demanded area of a context and a rising moving average. Sometimes the demand, which means the context, can be negative. If you reverse the context with the intermediate range patterns, no big deal. You just need to have a demand area, possibly with a signal. As you'll see, the momentum signal is going to be an optional system in here. Always better to have one. Okay, so having a signal would be great, but what we care about is most importantly having a cluster of both these demanded areas and the rising moving average. The moving average cannot be negative. It's absolutely not possible. Okay, And what we use as a signal filter in here is this double time frame sine wave cluster. Okay, we want to have both the trend sine wave and the shorter sine wave being in the reversal potential area. That will give us favorable cyclical condition. And an optional momentum that will always be pleased if it's there, but not necessarily 100% necessary. Okay, the stop loss on this pattern is going to be set below the previous low point. That's how it is. Okay, just simple as that. Never exceeding the 2% risk taking, because it's not a limit per pattern, it's a limit per context. You never get yourself exposed more than 2% at a current given time on a trend following behavior. Otherwise, you're breaking the rules and you're getting yourself into very dangerous corners. Okay? So that's what this is all about. It's not really complicated. This pattern, as you see, can take a signal, otherwise just takes favorable cycles into a demanded area with a moving average. That's the pattern. It's not really that complicated. It's actually quite simple. Okay, the validation is reached out when prices retrace right up to the resistance context. At a validation point, the only thing you're going to be doing is rising the stop loss down the lowest point that have been made. Of course, that gives you multiple options in here. Either prices will rapidly rebound out of the moving average area, and you pretty much have something real close to the bottom, which means when you'll validate the pattern, your stop loss will be risen right back to something close to your entry price, not at break even, never, okay, but close to your entry price, which will seriously limit your risk taking. You'll see all of this orchestrating on a more visible chart, and we'll do this slightly later on. On worst cases scenario, the prices will generally keep dropping below the moving average, normally without taking your stop loss if there truly is a trend, and will reactivate later on, which means reaching out validation, your stop loss will barely move because, of course, the distance you have between the bottom that has been made and the stop loss will be limited. Okay, so these are the general two types of reaction. Of course, if the prices does not rebound and just try to keep pushing lower, you shouldn't even scare you out. That's why you have a stop loss. You're there to absorb a limited amount of chaos with a limited amount of risk taking, of course. And most of the time, if the trend's really there, their stop loss shouldn't be even taken down. Okay, so that's what this is all about. It's not that complicated. There is no confirmation for this pattern exactly like the previous one. Okay, if you put the stop loss at break even, for other reasons, these are probably psychological biases, and we'll make a podcast about these ones after this one. Okay, so no break even, guys, please, until you have clear evidence and true reasons to do so, and we'll talk about these later on. They're pretty similar to the previous pattern anyway. The target is to keep it as long as possible and manage it the same way. As you reach out the divergence probability, you profit take, if possible, at least 50% of the trade or the entire trades, of course, if you want a safer approach. If you get yourself caught into the middle of a pullback, take your trades out on the third range boundary if the context has been reversed. And if you really want to heavily risk take, you can just don't give a shit about the pullback and wait for the final excess, which is, of course, higher level of risk taking, longer exposition to market, not the best case scenario for beginners. Always start safe and increase slowly but steadily the risk taking. We'll get along this on the next videos, of course. The conclusion in here is that in here, as the signal is optional, I mentioned it because it is great to risk limit. It is an additional, not necessary feature, but always great to help you measuring the shaded gray areas. So if you're thinking about whether you should take 1 or 2% risk with this pattern, then you should eventually consider going for the higher boundary only if you have a true momentum signal. Okay, if you have no signals, that doesn't mean you can't take the pattern, just means you might opt for the lowest riskier options. Okay, that's what this is all about. We're done. There's no need to go any way further. We jump into a chart right now because this is where the actual shitty trick will show up. Okay, so this is where we're going to have plenty of stuff to talk about, and more importantly, dive into the shaded gray areas. That's going to be the definition of more expert context, okay? You'll see down there that actually multiple decisions are still following the rules, which means you're going to have choices to make, and they will depend on how aggressive you are, but all of those rules and all of those decisions, as long as they fit the rules, are not equal, but they're still reasonably safe. Okay, so what matters in here is to give you room for decision-making processes with boundaries. You're not fully free to do whatever the fuck you want. You will have serious limitations, but still a little bit of room to make some more aggressive or less aggressive decisions. This is where psychology will get to impact your decisions into trading. And this is why the next podcast is all about that. Anyway, let's jump right into it. So I highlighted our previous pattern. We're going to take the same area as an example. And before we go any further, you might have figured out what the fuck are you doing into this time frame, Phil? You're not supposed to trade 2 time frames below, right? You should do that, all right? Weekly time frame is our reference breakout out there. So what the fuck are you doing in a daily chart? And the problem is just I cannot scroll to a lower time frame in this specific case. We're looking at 2013 prices, and there is no 4-hour chart history for this period. So for recurring purposes only, I really wanted to deal with the same area. That's the reason why I have to use a lot of trick in here. So I will use specifically for this purpose, and because I can't do any different, the chart on the daily chart time frame, which means we're going to have a look at the trend channel instead of the context, okay? And therefore, I shifted the moving average to a weekly chart time frame reference, which will be the equivalent of what you would see if you were looking at the lower time frame. Okay, so your moving average will be just right here, and this trend channel would be your context. Of course, that also means that we cannot see the local time frame sine wave. So we're just going to be able to see what would be the trend sine wave. Okay, so we're going to have to make some assumptions, but let me be clear, they totally would have validated anyway. Okay, so just a quick note in here, but if you guessed and asked yourself that question, that's the reason why I'm cheating a little bit. Okay, so anyway, same thing as before. This is the area in which we validate the breakout, or there, depending on where you place the breakout level, there or there. But no worries. Anyway, both case scenario, this is the first time we can work around both patterns. So as we go down, you see we're reversing the context. We build a third range boundary. It validates. So we know that there's going to be a stop bullish trade for you out there. You already place yourself in the market, but your second pattern triggers. You're reaching out the moving average, you've got your demanded area out there, you had a signal, and you have favorable cycles. So what do? Your distance to stop loss is, your stop loss must be in here, okay? Put it right below this level. That's a slightly bit more expensive, but no big deal. You rather like to be safer, put below the previous bottoms, okay? And of course, always below this thing. Just a quick note, from time to time, your context will be so wide if you're dealing with prices right after the breakout. And here is a specific case in which the trend channel is really narrow, or the context is really narrow. If that ever happens, okay, take yourself as a limitation. You can put your stop below the higher time frame moving average. That help on some cases, but most of the time the context will do the job. Okay, so this is our extreme context. Remember, as we are in the higher time frame, you would place yourself below the extreme context. So that's just a quick side note, okay? If your side context, your higher time frames context, is really far away from prices, you can use the moving average instead. That will help you reducing the risk taking, but without taking too much risk. Just a side note, okay? So in here, your stop loss is there, and you will take that trade. So what do? You have a 2% capped limitations. You can't go beyond that, otherwise you're breaking the rules of this context. Never exceed 2% risk taking at a current given time. But you know that there's a pattern that will trigger out there. So the advantage of having two patterns acting in a symbiosis means they're generally triggering the same price area using different patterns, different structures, different stuff, which means it's always better to use both of these rather than going all in with just one. You have a 2% risk pool to expose on the market at a maximum possible rate. So either you have a strong fucking confidence and you really want to go down 2% risk taking on just one of these two patterns, or you smartly think that, well, it might be better if I go 1% for both. And it actually is great because you would rarely have to use 2% on this one, just like as this one. Remember, that's a maximum that you only reach out when you have fully confident decision-making processes. But as you have two patterns, it's going to be much easier to go 1% one, 1% the other. And the risk limitation is far better having two patterns than playing it all around with just one. Because of course, the probabilities of failing one pattern, Schrödinger cat box version, is just you've got one box and either the cat is going to be dead or alive when you open the box, which means it's basically like 50-50 game. Is the pattern going to be successful or not? Of course, the reality is higher than 50% because there are some external risk limitation The trend should be favorable, so you have more statistical chances to be successful than to be failing. But still, if we go on a Schrodinger's cat version, it's still 50-50, okay? You don't know what the outcome is going to be. If you have two boxes, then the outcomes are different. You can have two successful boxes, you can have two failing boxes, but you can have one and another. And that gives you plenty of shaded grays. That's where we go into these things. So using two patterns, even though you will get to the maximum 2% cap, is much, much better in terms of statistical risk limitation than going 2% on just one of these things. Okay, so that's why the symbiosis will be better, because it will allow you to safely guard yourself and still using the maximum possible leverage, because you compensate and you distribute that risk into two patterns that have absolutely no correlation. Let me just give you a quick example. If you go 2% risk taking with this pattern, and if the market for some reasons is failing its breakout, you will get out there and flush out. You will take a 2% stop loss immediately. If you take just 1% risk out there, knowing that you will add up another 1% out there, okay, you would say, well, okay, but the pricing here is far better than this one. Yes, sure it is. As you risk take, and as you risk limit, you'll also limit the reward. It's absolutely all about it. But what's negligible out there is that if you think of it that way, in a trend, we want to let go with the position as long as possible. This is where the difference takes place. Because in here, in the end, if you consider taking profits in here, where we've seen on the previous podcast, this trade is not going to make that much of a difference compared to this one. But the risk limitation is, if for some reasons the shit hits the fan, but for the second one triggers, you're just going to lose half the you're going to take half the loss, which is significant. For just a slight increase in benefits, you limit the potential loss significantly. So statistically speaking, this truly works better. You spread out the risk into stuff that have partial correlation, which means all of those patterns, as you see, they will occur into the same price area always, but they have totally different psychology and patterns to trigger. So that's why they can be added and add value, okay? Don't add up similar things with similar technical signals. That doesn't matter and that doesn't work. So in here, 1%, wait for the market to prove you that it works and take another percent, okay? What happens next? You reach out validation for this one. It's great, okay? Which means at that point, what do? You can rise the stop loss down the previous bottom, but it's pretty much already there, okay? So you don't change anything for this pattern. Remember that you do nothing but just considering that it has been validated, and you let yourself go until you can put it at break-even safely, which is when you reach out another pattern later on. So this one has its stop loss in here. This pattern has a first stop loss down there, okay? And it validates in here. So when you enter the second pattern, the first one gets validated. But what happened with this one? This one means if you follow the rules, as you got pretty much the bottom, you can put the stop loss in here, which means this trade is no longer risking 1%. So you have a choice, a first choice in which you have options. So if you're really strongly confident, then you can take more than 1% on this one to reach out the 2% cap. This one could be traded with a 1.5 or 1.6% risk taking on capital, because this one no longer risks 1%, but just probably 0.2, 0.3. So at that point, you have a choice. If you want to go for the maximum risk taking at that point, you can increase the initial risk taking. You can do that, or you just stick with the plan. You took 1% risk, and you just limited the risk taking as this one gets validated. That's an intermediate, more moderate approach. What's nice with this option is that as this trade gets validated, you have the intermediate pattern in which it pulls back. Okay, you cannot use the red pattern with the black one after another, unless specific aggressive cases, which we do not talk about now. But when it shows up in here, you still have the second pattern that triggers this one. This one has a positive moving average. You do have the rising cluster. So these prices in here, do we have favorable cyclical condition? Yes, we do. So can we go down this road? Yes, we can. Yes, we fucking can. But why can we do this? Because the previous pattern didn't make a dip below our entry point, which means we limited our risk. And at that point, we have taken 1%. This one no longer risks 1% and has just like 0.3% risk. So we have 0.7% capital to invest if we want to, which means you have a choice. And both outcomes are good. If you do not want to, then that's fine. You're just taking less risk, which means if shit hits the fan, you're losing less money. But if you want to reinvest, you will make more money because you have 0.7% capital to invest in here, which means if it succeeds and pushes prices right up to your end far away targets, because that's the goal in here, you only get profits because it lasts longer. Otherwise, it would be negligible gains. It totally brings a shit ton of gain because you're taking a higher level of risk. Of course, that's always at the expense of a higher loss if it ends up being wrong, and it totally can at every given time. Chaos is always there to hit you hard, but normally chaos should be limited as trends should be plotting themselves on. That's how it goes. So as you can see, multiple options, multiple choices, and there's no good or bad decision. There is just, well, it works both ways. It just depends how much you're willing to get, how greedy you are, and without ever crossing a limit. It's not limitless free options. It is constrained, risk-limited option in which you still have room for personal choices. Okay? So now let's go down the next road, which really seems to be important. What would you do with this one? Of course, this trade in here gets in here, which means it's validated. All right? It is validated. So the stop loss is risen right below the previous low point, which means this one in which you took 0.7% capital risk now just risk barely 0.2%. So you could still go for another 0.5% risk taking in here. Would you do it? Once again, it follows the rules, but what's going wrong with this one? This one shouldn't be taken for a simple reason. At some point, increasingly risk-taking is not going to be profitable. It could still be, but in here, this 0.4% risk, knowing that you already have 3 trades into the same tradable area, seriously increases the risk to a point that does it really value, or do you actually over-risk take? I think at that point, this one kind of breaks that limit. It would be the 4th trade into a single tradable area, which means kind of risk-taking. Going for 2, I would totally understand that and be happy with both decisions. This one I think is too much. But once again, multiple options. If for some reasons you took this trade and this trade, that this one has been secured, you still have your pool and you decided not to take in here. So you still have a 0.7% risk pool to reinvest. If you're willing to reinvest on this one, I'm totally agreed with that. Only if you didn't take it on this one. Otherwise, taking both would be too aggressive. One of these, whichever this is okay, because in here you have the same cluster again. Rising moving average, demanded area, favorable cycle, and you still have room to place your stop loss. So it's okay. It's totally okay. Anyway, so that was area 1. Now we get out of it. Very nice gain booked in the market, depending on how much trades you took. No big deal, okay? It's just a matter of aggressive decisions or defensive decisions. But personal decisions, both of them being totally okay. Then, of course, we retrace again, we break the context, so we know that the third range boundary is coming along the way. Simply, it does not, and we reach out the moving average already. So this pattern triggers first. Last time it was the other. This one triggers first. Okay. So yeah, still, let's go. We're shuffling the deck, but it's still the same game. It fits the pattern we play it along the way. So we do have a cluster of rising moving average, our supportive context. We do have favorable cycle. So let's go. All right. We go in, we take the trade in here. It's not as bad as, it's not as good as the previous one. Now we do have our stop loss in here, slightly below the context. And therefore, okay, prices in here falls a little bit without taking your stop loss, of course, that's great. But in here, that means your risk limitation at validation level will be pretty narrow, which means you have no room for risk reducing because you will have to leave the stop loss below the low point. Okay, so the difference between the two is that this one will give you no margin for error later on. But still, you retrace out there, and you look at the prices. Does it build a third range boundary, which means I'll be able to break out trade it, or does it not? And does it trigger the red, the squeezed pattern? In here, squeezed pattern. So what's the next choice? Okay, always the same process. I'm following the goddamn rules. I need to reach out the 1-to-1 ratio, and if it does, I'll be able to call for the pullback trade as a limit entry on the market. It does, so I put my limit entry. I still have this trade with its stop down the low point, and it's still approximately 1% risk taking. So I know that I'm willing to take 1% risk on this trade, but I do have a tricky question in here. When this pattern triggers, I have my limit trade executed, but I see that there is as well the moving average and the cluster, and I have room to pay a stop loss. Damn it, I'm really willing to think about putting a double trade out here. So am I taking 2% risk in here, or just 1% risk as I'm supposed to do? The thing in here is the same old problem: multiple choices, multiple aggressive decisions or defensive decisions. So in here, the options you have is that you cannot break the 2% limit. So if you want to invest 2% in here, you have to put this trade at break even. The question you might wonder is, when you are there, do you truly want to put this stop at break even? If you think yes, then I would understand that you take a maximum 2% risk on this trade because you have the two patterns triggering at once. That is a fairly aggressive decision. It's going to bring a higher level of reward, of course. But what I would say in here is balance all the informations. You've been pretty aggressive in here. Do you really want to be aggressive again? That's, of course, not a good to bad answer. Both answers are okay. It's just one is fairly more aggressive. And remember that if you go parabolic on risk taking, sooner or later, the shit will catch on you. Okay? So don't be aggressive all the time. Modulates aggressivity. I think in that perspective, the rational decision is, well, if you've been aggressive out there, don't be out there. Just go for a simple 1% risk and keep the stop loss out there for the second position. Okay? So as you can see, personal decisions, and two traders with the same strategy will make two different decisions out there because each and every one of us is unique and will make unique decisions because we're starting to get in areas in which we can modulate decisions, still following the same rules. And both case scenarios are okay. One of these traders will eventually make more money, but if you take 100 trades out of these, what matters is that both of them are fairly greatly profitable. The more aggressive trader will probably be a bit more rewarded, but will also have more volatility on its account. Because sometimes taking risks will cost you stop losses than the other guy who has more defensive decisions will not. So it all modulates in the end, okay? Anyway, we'll talk about that in more detail later on, but I'm starting to introduce those perspectives into you, okay? We're really starting to get into experience stuff now, and it's really what matters into trading. Okay, so next, in the end, we go real quick, okay? We get out of this area, no matter which decisions you've taken. Okay, we go there, we reverse the context, another pattern will trigger on the third range boundary plotted scenarios. You just wait for the third range boundary to come, but in the meantime, you've got the moving average stuff that triggers. So you take the trade. Do you have favorable cyclical conditions? Yes, you do. So you get in, okay? You get in with a 1% risk because you know that you always keep a pool of an additional 1% for your third range boundary pattern. You get to the third range boundary area, the market doesn't validate, it breaks the pattern, but doesn't reach the 1-to-1 ratio, so you do not put your limit order to buy it out, but you still have validated your first pattern, which means in here your stop is negligible, right below the low point, and it's taken down by the market. So in this perspective, if you zoom out the entire process, okay, in here you totally fuck up the moving average, which means you stop playing the pattern. You've already missed this one as well in here. So both patterns failed in there. You know the divergence is very likely going to show up. So you also know that by the next pattern's target, you will lock on your gains, okay? But most importantly, what you should figure out in here is that there is a difference between the two patterns. One is triggering 3 times, and the last time it triggers is not a trigger, which means it doesn't meet the pattern, so you will not take a loss in here. The other pattern triggers 6 times, which means you will have choices on which one you want to pick, and you certainly cannot pick all of these, and the last one will take you a loss. A tiny one, of course, because the loss in here is very limited, but still going to take you a stop loss. So this one provides better prices, more aggressive as it triggers more time, it triggers more often, though you will have to be less aggressive with this pattern. Make less aggressive choices with this one than you do with this one. Spread out the risk into a logic. That's what professionals do. They spread out the risk by using multiple patterns. What you need to understand, the patterns must not be correlated, but they will still somehow tend to play in the same areas because prices are interesting into areas that matters. And you will likely not have patterns into uninteresting areas. That's simple as it is. The other thing is that going beyond that, adding multiple patterns to get more and more opportunities doesn't make it better. Considering it like we've said, okay, go for a 1 to 2, okay, that gives you 0.5. If you divide 1 by 3, that gives you 0.33. If you go 1 over 4, it's 1.25. Okay, so what you end up getting is a decreasing parabolic structure, okay? And in that perspective, the higher the number of patterns, not necessarily the better in terms of risk limitation. Considering it that way, when you use 2 patterns, you definitely risk limiting as best as you can. With 3 patterns, it's going to be better, of course, but that means you need to master 3 patterns. It gets more complicated. And as you get 4 and 5 and 6, you nearly don't even benefit from this by just getting over complex, which means you're going to have to master more rules and you're going to be more room for error and stuff like that. So I definitely can tell you 2 or 3 is the way to go. If you want to go simple and easy, the minimum is 2 because that needs 2 patterns at least to create a symbiosis. The symbiotic system just is a 2 combination. Make sure that there are no closed corners for these patterns. Otherwise, you cannot add up stuff that just is the same. Okay? So that's what it is all about. I think we've got more than enough information to reach out a decent conclusion at that point. All right, so here it is. I'm sorry, it is approximately a 40-minute video. We're getting into some more experience stuff, and before going down there, I really wanted to set the ground rules. So still going into a lot of explanation, a lot of detail, so you really understand what the processes we use into getting into some more experience stuff. We're getting into the shadowed gray areas. That's really what matters, and that's also, I think, at that point, the beginning of your understanding about what trading really is all about. At that point, if you get what I just explained to you today, which is crucial for you to understand what trading, professional trading is all about, it's about optimizing decisions. But at some point, there will be multiple viable decisions, and it's just going to get even more complex as we'll get into the experience stuff. So we're really scratching the surface out there. You're really getting into some stuff that gets pretty interesting. And we're just getting started. Really we are. But the thing is that at that point, if you survived, normally you're making money. There's not even a question that you're still losing money at that point. If you apply these things, you can just be profitable. There's no other choices. You can still make mistakes a little once in a while because psychology is always there to fuck you up and alter your decision-making processes. But normally, as you do master these things, you cannot be anything but profitable. The thing is that there's always limitless possibilities. And as we progress into this series of videos, we can get much deeper into the rabbit hole. There's some more experienced stuff to tell. And the thing is that as we get more complex, there will have to be more patterns. What we've just done today is to digging into some things that we'll use a lot into the expert patterns, but in a more complex manner, as we will have to take more risks. Because what we'll basically do with the expert patterns is using some kind of the things we've seen today, but today we were limiting the risk with the probability that the trend was there to support us. The expert patterns are basically doing the same thing, but outside of the trend. With the divergence pattern, with the reverse pattern, this will be things like that in which we'll use risk limitation outside of the safety belt of the trend. So this gets really trickier. It's doable, but we're going to need patterns, more patterns. So as you've seen, with the trend behavior, 2 patterns is absolutely great. Doesn't have to be 3, 4, that doesn't necessarily add up. You'll still be far profitable with 2 patterns. Having just 1, not really that great. It's really much better with 2, not just because you're going to maximize the risk taking, but what you're going to do it with a safe risk spreading purposes. Okay, you spread out the risk, which makes it much better to spend 2% risk on 2 patterns than doing it on a single one. And that's really important. Okay, gaining any way further than that 3, 4 doesn't make it really better. Complexity will be necessary for the expert patterns. We'll dig into this later on. In the meantime, before terminating this trending series, we're going to have to make another podcast about psychology. Because the thing is that as we'll introduce multiple trades in a pattern and into an asset, you will increase leverage. And that will create a lot of psychological issues. Things that you won't necessarily control. That's the thing about natural biases. You don't really see them coming, and they will alter your judgments, your decisions, and all of those things into trending context. So we're gonna have to talk and make a podcast about psychology. That's gonna be the next video, really interesting one. We're gonna talk about how aggressive behaviors can be very dangerous into trading if you have certain types of psychology, how very defensive persons will get into always the lowest risk decisions, which is not great at all. We're allowing multiple patterns to allow you taking more risks. So you're going to have to force yourself into risk taking if you're really a low risk all the time person, okay? So you have to get to some more moderate approaches. That's what we look for, average, moderate decisions. That's what we lead to. Okay, of course, we're going to talk, of course, about the bullish natural biases and the bearish biases. There are some people who sell a shit ton lot more than they buy, and they're exactly opposite as well. We're going to have to fight those biases because they will alter seriously your trending decisions if you do not fight them. Just like we stated previously, now you understand why it takes 3 to 6 months to work around nice mastering of trending following behaviors. Because first of all, you have to master patterns, but secondly, there will be those psychological biases we'll talk about. And just like it took 3 to 6 months to figure out the first biases by slowly, naturally pulling them away, we're going to have to do the same thing with these trending behaviors. And they take at least 3 to 6 months to produce results. So if you put yourself risk maximum taking before having the necessary psychology to avoid falling into traps, you understand what it goes on, okay? So we get into this psychological stuff, and then we'll probably have a few additional things for trend following purposes, but we're nearly at it, okay? Most of it is done so far, and then we jump into the most experienced context. Bye, guys.